Hello, my Pixel peeps. Nicole Payne, CMA, here as always to drop some accounting truth bombs. And today I wanted to take a moment and jump on to give you a brief overview of business valuations. This is a question we've been getting more frequently in the recent months from clients of ours asking things like, how much is my business worth? How much should I sell my business for? How much should I buy this business for? Is it worth what they're asking for it? And this is, while it's not something that we specialize at Pixel, there are companies that specialize in business valuation. If you are asking any of these questions, definitely have a company that we would recommend you to go talk to because it is a hairy beast. It's a moving target. There are so many factors to consider when you are looking into these things. So I highly recommend that you speak to a specialist. But I just want to give you a quick overview. Typically, there's about 4 ways that you can value a business. The first one being a book value. Now, this is something that we can provide to our clients because it's based off of the books, just like it sounds. So you take the financial statements. The book value is assets less any liabilities that are owed by the company. So it's also, equity. If you remember, your assets equals liabilities plus equity. Assets minus liabilities equals equity, which equals book value. So it's really simple and down and dirty, but it doesn't take into account any future earning potential of the company, which is why it's not typically used as a valuation method when you are buying and selling equity in companies. Now, methods that typically are used are multiples. So just quick reference points, multiples can be great because essentially you figure out what is standard for your industry or the industry of the company that you're looking at purchasing, and you find out what that multiple would be, and that's how you value the business. So there's a couple ways of using multiples to value the business. The first is multiple of gross revenue. So you might take the annual gross revenue for the last 12 months and multiply it by 1 or 1.5 or 2 or 3, whatever is standard for that industry, and that becomes your valuation. Another multiple is multiple of Ebitda. So you might remember from a previous video, Ebitda is earnings before interest, taxes, depreciation, and amortization. So the reason you would take that number instead of net income as your multiplier is the fact that interest, taxes, depreciation, and amortization are all going to change once the company changes hands. So if you are buying a company, you may not be continuing to depreciate or amortize under the same set of rules that the previous ownership was depreciating or amortizing. You might not have the same debt load, so your interest is going to be different. So using a multiple of Ebitda is more accurate to the overall company that you will be acquiring or distributing, selling off. Now, the most common method for valuing businesses is also the most complex because it has so many factors that need to be considered. This method is called the discounted cash flow method. And essentially, without going into too many details, you take the predicted cash flows from 3 or 5 or 10 years in the future, you discount them using your required rate of return, or the amount of return that you are wanting to get on your investment, and that becomes the sum of those numbers becomes your business valuation. Now, the trick here is determining, one, the number of years in the future you're going to project out the cash flows, because the farther into the future you go, the more likely it is that your numbers are not going to be very accurate because you can't predict with very much certainty more than a couple years in advance. 2, you also need to consider your required rate of return. You need to consider your industry because your industry is going to change how certain revenues flow and certain costs are going to change. But once you've kind of corralled in all of those different functions and features and considerations, you can get a fairly solid number for your business valuation and be fairly confident that you're not going to be overpaying for a company or you're not going to be selling yourself short. All that said, this is, again, a very complex topic that I wanted to condense into a very brief, cursory overview. If you do have questions about business valuation or you need a business valuation done, feel free to reach out because we do have contacts with people who specialize in this and can get you the best, most accurate valuation for your purposes. And take care, everybody. We'll see you on the next week.